Joining us now is Sanjay Doshi, who is from Abakkus Mutual Fund. Sanjay, thank you very much for joining us today. Uh, how do you look at the entire market at this point in time? It's a narrow range which it's moving in. There's no triggers for the market to move ahead.
Yeah, very good afternoon. Thanks for having me on your show. At Abakkus Mutual Fund, we started our journey in December 2025 with the launch of our FlexiCap fund, and today we have three schemes. We have been fairly constructive on the markets right from our inception. We believe uh, our preference lies on the small and mid-cap side. We believe key to this would be the structural India story as well as the opportunity on a global footprint in terms of manufacturing as well as certain segments on healthcare. So that's where we are very focused on. We believe India is very simply a 7-8% real GDP economy in terms of growth. We see that as an opportunity for the next 4-5 years. And inflation should be in the range of 3 to 4%, which means we are looking at nominal growth of around 11 to 12%. In which scenario we anticipate mid and small cap to do much better in terms of earnings growth. This could be in mid-teens to high double digit in terms of 20 odd percent, and that's what drive the markets. If you look at the last 3-4 quarter numbers also, the trend is very clearly visible. Despite all the global macro challenges as well as certain domestic issues on currencies and crude availability, we have seen companies do much better on earnings. In fact, the first quarter that we concluded, we saw the mid and small cap perform exceedingly better with a good 15 to 35% kind of earning growth across companies. And we see this trend continuing, which will drive the markets going forward.
Makes sense. Sanjay, your positions have been talk of town, right? Every new position is met with the stock price going up as well. But talk to us about what sectors, pockets are you liking at this point in time?
Sure. So before we go to, these preferences, I would also like to highlight at Abakkus Mutual Fund, we are very particular about risk management, also risk framework, and therefore you will not see any disproportionate positionings across our portfolio. It will be very balanced portfolios. Coming to our preferences, manufacturing is definitely one segment which we are very bullish on. I think the intensity of manufacturing within the economy at around 14-15% is much lower. If you think from a global trade perspective, also in terms of goods, we are like less than 2.5, 3%. And there is enough opportunity for us to grow, especially when we are looking at various supply chains being looked at as a preference to have a very reliable supply chain apart from China. We will also see a lot of initiatives by government on making India self-dependent in many areas, including say defense, electronics, and I think all this trend bodes well along with technological changes for manufacturing. We also do have very significant capabilities on engineering and niche spaces, and I think that's one segment which we are very bullish on. Similarly, we are very structurally positive on India consumption story, especially if you look at the premium end. We believe as the economy moves from 4 trillion to 8 to 9 trillion dollars over the next 5-7 years, the trend of consumption will keep on improving. Per capita income rising will see disproportionate spending at a higher end. And this also supports our positive view on capital markets and wealth platforms. So these are the 3-4 areas. Not to forget, healthcare also remains a very dear sector to us. We are little bit selective on hospitals and diagnostic, but we are fairly constructive on CDMO opportunities that Indian companies do have.
Sanjay, within the mid-cap pack today, we are seeing some bit of activity happening in power and some consumer durable and pharma. How do you look at these three sectors?
Yeah, within power, I think there is some news about how US is looking to restrict certain supplies from China, and I think there could be opportunities for niche players in India. Whether they are India corporates or MNCs working from India. So I think that's one factor. When you think about the space like pharma, I'm very sure you would be looking at the US generics as well as the CDMO opportunity, where there are again a lot of regulatory changes, lot of drugs going off patent and the trend which we are seeing in biologics. I think that's all bodes well for some of the niche companies that are there in India. The trend of looking at sizable, scalable opportunities within CDMO, apart from the leaders in China, is also very relevant. And I think that bodes very well for some of these companies in India which are working in that space. And also over a period of time, specialty chemicals will pick up. So we remain constructive on most of these places, but we would also like to highlight caution in terms of the valuation of some of these companies. You would have seen a disproportionate move in a very short period of time. We would request investors to be very mindful about cyclicality of earnings, the longevity of profit growth, and the kind of multiples you assign at what part of the cycle. So if these companies are probably at a peak end of the growth cycle, it would not be right to assign them the highest multiple in that stage. So I think that's where we would be very cautious on valuation, while we are mindful of the larger opportunity that sits here.
Sanjay, very difficult to ask you on stock specifics, but I know that QSR for a fact is, and everyone knows this, is something that y'all are liking. Give us the thesis there, what's playing out and what's keeping you positive despite it not being profitable yet, and profitability likely to come back maybe a year or two. Give us a sense.
Yeah, I think, see, if you think about that space, again, growth was a bit of a challenge. We would also have seen consolidation happening across the space, which or the change of hands of management in some of these companies. And what we are likely to see going forward, at least the near-term trend suggests, is there is a pickup in demand. At the same time, while there is inflation in the near term in food, and probably we'll have to be mindful for the next couple of quarters given the monsoon spread that we are witnessing. But if you think about it from a 3-4 perspective, I think finally after a point of time, we have seen consolidation as well as growth coming back. The profitability angle, you're right, it takes some time for these companies to mature, for their footprint to mature, because there's intensity of capital and opening of new stores or new restaurants is very high in the early phase. But I think over a period of time, they're able to sweat their assets well. These companies could make reasonably good profits over a period of time. I think there has been enough consolidation from investor side also, and probably it's a space that is quite getting more interesting from a 3 to 4 year perspective.
How are you looking at banks, Sanjay, at this point in time? It's you're seeing valuations well off the 5-year highs. In fact, we're sitting at the lows. And even versus averages, you're seeing a significant discount in terms of relative valuations. Credit growth has picked up, though. Would banks be something that should come into favor maybe the next year or two?
So we were quite bullish on capital market plays in the initial part of our journey. We definitely saw that trend pick up meaningfully, and some of these sector leaders have done well. Coming to financials, yes, the large financials or banks in particular have probably seen a disproportionate hit on account of foreigners selling. Their positioning were very high in that space. And we saw from March to June, up till July, the FII flows were very negative. In which case, I think some of these spaces have taken the bulk of the negatives. Leaving aside the company-specific issues, I think, as you highlighted, credit growth has picked up quite meaningfully. I think after probably 2 years, we are seeing good double-digit credit growth. I think the cost of deposits or the that is also getting addressed with the FCNR bonds and the kind of flows that are coming in, along with the deposit mobilization happening on the domestic side. So I don't think the NIMS pressures are going to be very strong. Credit cost has been benign. I think the best part of the credit cost is behind, but we don't see any blow up happening in the near term. As far as rate hikes are concerned, I think a marginal hike maybe in the coming quarters could be positive for profitability of some of these banks, as they will be getting an opportunity to pass on certain cost and thereby make better NIMs. So we remain constructive. In fact, valuations have corrected, as you pointed out, and some of these are very, very attractive from a price to earnings perspective, especially for banks which have done consistently well over the last maybe 2 to 3 years. So we remain constructive on banks as well as certain NBFCs in spaces like gold finance, housing finance, and SME financing.
Last off, I see that in your portfolio there's a differentiated tilt towards infrastructure as well. So that's a theme which you all have either already been playing or you all are liking off late. Where in the cycle are we with regard to infra, and how do you pick within that infra pack?
Yeah, so within infra and engineering in particular, we have been fairly constructive. When you look at some of the pure infrastructure companies, EPC companies, they have had a very tough time, especially in sectors like roads. But we have a tilt towards more urban infra, where there are certain niche companies who do a lot of work in port development as well as say metro construction or railway side. And I think those become very attractive over a period of time. Considering that we are just starting our journey on modernization of railways and looking at India as a export hub. So you need very strong port development. I think these becomes very interesting. Some of these have very unique capabilities. The order books have improved meaningfully. I think it's a matter of time once this execution picks up, you'll see profitability also come back. And when we looked at some of these names in our portfolio, they were trading at 50% discount to the normal price to earnings or multiple that they used to trade at. So that became a very positive combination for us in terms of improvement in fundamentals as well as getting it at a pretty cheap valuations. Coming to engineering side, I think there are very niche engineering companies in India who can provide a lot of opportunity in space, in high-end manufacturing and electronics. If you think about semicon and fab manufacturing in India, I think you require very different environment, and I think these companies would play a very major role, whether they are on industrial gases or whether they are companies who are providing you with a significant improvement on water purification as well as an environment to do high-end manufacturing in terms of temperature and dust control environment. So we are very bullish on this spaces. I think this macro journey of India looking to improve their manufacturing capabilities is very structural. And we also have good cost dynamics to serve the global supply chain. And I think that's where some of these names would come into investor focus, and we would see significant re-rating in their valuations.
Okay, Sanjay, one sector which has been active also, as well is the defense pack. Do you have exposure there, and what's your view on the kind of valuation many of the stocks are trading at?
We do have exposure to the space, but we are very selective. As you rightly pointed out, some of the key names are at a very high valuation or stretched valuation. But the overall opportunity within the defense manufacturing space is fairly real, especially if you think about it from a private sector exposure. I think some of the large platforms are now getting matured, and we require right kind of supply chain. There is also an intent from government to get private sector involved, given the kind of work that needs to be done on large platforms as well as the modern warfare systems on drones and anti-drones and relevant air warfare. So I think there is a very strong opportunity, but as you rightly pointed out, we have to be mindful of valuations. We would probably look at companies who can give you exposure not only to defense, but some other relevant spaces like, say, maybe railways or mining or power along with defense. Or there are niche companies who are in the value chain of defense, which are not well recognized by the market. So I think that would be an area of caution in terms of valuation, and try to be selective. I think trying to be ahead of the market in identifying certain niche supply chain names would be probably better way to play today.
Okay, Sanjay, wonderful speaking. I mean, we can go on, but thank you so much for coming in and speaking to us nonetheless.
Thank you for having me. Thank you.